Hello everyone, this is Vinny from Compound Improvements. Welcome to the channel, and today the topic is the biggest investing mistakes. The reason why I'm doing this video is because knowing what not to do is as important as knowing what to do. So there is a lot that is happening in the market, and it's very difficult to understand the things that you should be doing versus not doing. That's why this video is for you. Number one is trying to beat the market. I'm gonna put on the video screen just Buffett's performance over the last 15 years versus the S&P 500. And you see that even the greatest investor of all time is no longer able to beat the index. So why do you think that you actually can? Many hedge funds, they try to beat the index every year and they still fail. So for 96% of all the investors, they would be better off sticking to index funds. If you are part of the lucky 4% that actually changes every year, that 4%, you really need to dedicate a lot of time into improving your stock picks. But for most people, they are better off sticking with index funds. So the question then lies, why doesn't everybody just buy index funds and then leave it instead of insisting on making investment mistakes? I believe that there are two reasons for that. The number one is lack of knowledge, and number two is that they have the ambition to outperform the index even though the odds are massively against them. Number two, paying too much admin fees. Admin fees will eat your return. If a fund is returning 10% but it has a 2% admin fee, your net return will then be 8%. And that compounds over time to a much bigger number. Every time that you buy or sell an asset, your broker will get commissions for executing that trade. And that's why you want to trade as least as possible. If you look at Buffett, he just buys and holds, and he's the greatest investor of all time. And guess what? The shorter you hold an asset, the more taxes you pay on it. So the solution is to invest for the long term. Number three, not diversifying. In a nutshell, in order to reduce risk without compromising your returns, you should invest in 15 uncorrelated bets. That means different assets such as stocks, bonds, commodities in different continents, Europe, Asia, America, in different sectors, food, tech, advertising, and from different companies. Those are uncorrelated assets. So, and it's really important that the concept of diversification is mostly misunderstood, but if you can have 15 to 20 uncorrelated assets, it's well diversified and can still maintain good returns. Number four, buying high, selling low. If you ever read the book Thinking Fast and Slow, you're gonna come across a concept that is called regression to the mean, in which asset classes will gravitate to their average growth over a course of time. For example, if you take a look at emerging markets, those stocks, they soared like over 39-40% in 2007, but then they fell about 53% in the next year in 2008. What has done well lately is a worse investment opportunity rather than better investment opportunity for two main reasons. Number one is that it's more expensive. So would you go to a supermarket and buy more when not in promotion? And number two, regression to the mean, as in the price is likely to bounce back once you had a bad or good return. It's more likely to do the opposite in the future. So what has done poorly is in discount and likely to come back up, and therefore a better investment opportunity. Number five, trying to time the market. Nobody has a crystal ball. Nobody knows what happens next. Nobody can pick this up and look, where is the market going? No, that doesn't exist. Number six, not automating investment contributions. So if you ever read some of the books about automating investments, that's what they mean by dollar cost investment. Every time that you invest an equal dollar amount in the market at regular intervals of time, the idea is that you get the best deal on a desired investment by controlling market fluctuations by investing the same amount every single time. So rather than trying to beat the market, you buy in at a range of different price points. For example, let's say you automate your monthly contributions to $1,000. Every month, $1,000 will go into your account and buy more of the shares if the market is down, and because those shares will be cheaper, or buy less number of shares if the market is up because those shares are now more expensive. Number 7, operating on a first level thinking rather than second level thinking. You should be thinking about what are the other players in the market doing. When something hits the news, it's already too late. First level thinking is, I think this stock will go up because the company's plan is strong, management is good, marketing will work well, and the balance sheet is solid. Second level thinking is, what other people are thinking and how can I differ from them and be right? So if a news come like, oh, Apple just released a new innovation, okay, you should be asking, who doesn't know that yet? If everybody knows, then it's already embedded into the price. Number 8, operating out of your knowledge zone. So look for your edge in the market, such as industries that you understand, e.g. that they are already in your work on your 9 to 5 job. Because, for example, I work in the FMCG industry, which gives me an edge whenever it comes to FMCG stocks. I know better than any outsider which companies are doing well and why. Moreover, living in London gives me another edge on what's happening in the financial world. So I'm not talking about insider trading here, but rather industry know-how. Know what you own and use that as your edge. Number 9, thinking that they can predict the economy, interest rates. Again, nobody has a crystal ball, so forget about macro. Number 10, not learning from your previous investing mistakes. Being flexible and humble and learning from investment mistakes is really important. Before you make a purchase, you should be able to explain why you're buying that stock. Take notes of it and go back in a year's time to review it if it has grown or declined, or if the story about that particular company has changed. Number 11, not checking the balance sheets. Checking when the debts are due. How does the cash flow actually look like? Is it growing or declining? Does it meet their own quarterly targets that they set for themselves? If the company really believes in itself, then the company is buying back shares and insiders are also buying into it. Number 12, not taking advantage of the bull January. Since 1950, the S&P 500 has gained on average 1.8% in January, compared with an average rise of 0.7% in other months. So, if that is the case, you should be buying stocks in January, because the likelihood of it increasing in January is higher than in other months. Number 13, not studying the fundamentals. It's really important to check the ratios of companies versus its peers to understand whether they are doing particularly well in the industry or not. Some of the important ratios that every value investor should be looking at is the PE ratio, which is the price per earnings. The PE ratio will show you if the company is cheap or expensive in relationship to their quarterly earnings being distributed to the shareholders. The funny thing about PE is that the lower, the better. So according to Mary Buffett, if you have a PE ratio of over 40, you should consider liquidating your investment, even if you believe that in the underlying stock, as it would then be very expensive. But that being said, if you look at companies like Amazon and Tesla, they've always had PE ratios of over 100 and still keep growing. So there are exceptions to the rule. Return on net assets. Is the company capable of producing great returns on their existing assets? Are they able to squeeze the juice out of their assets? In terms of return on net assets, the higher the better. Warren Buffett looks for at least 25% on return on equity, which is a cousin of return on net assets. Price to book value. If the company had to liquidate today, how much would their book value be worth? How does that compare to its price? Again, the lower the better. Number 14, availability heuristic in investment mistakes. So Availability heuristic is the same thing as availability bias. It's a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a topic, concept, method, or decision. Don't fall in the trap of it's the Airbnb of that industry. It's hardly a reality. Last but not least, the law of holes. So if you find yourself digging into one, quit digging. Admit when you've made a mistake and move on. Stay in your circle of influence and don't let the sunk cost bias affect you. Even if you've already put money, investment of time, or other type of investment, if you figure out that you're wrong with new information, move on. There you have it. So the 15 biggest investment mistakes. Try to avoid those as much as you can. And if you like this video, please hit like so you help the channel, and subscribe to the channel as well so that I can see you next time. See you later, guys.
And you want to have the right heroes. You want people, if you want to emulate somebody, you better pick very carefully.